Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Tuesday, December 27th, 2022. It's now Sunday, the 25th at 8:10 a.m. Central Time. We start off in the S&P 500 daily chart in the mark, looking back to December 2021. I'll zoom into the current area now. The S&P 500 daily chart has printed the combo and sequential sell setup 1 count, and to negate that, for end of day the 27th, there must be a close below 3821.62 for the price flip to the buy setup count 1. For the first move above the supply line here, we now wait to see if the next opening bar opens higher than this close and then ticks higher intraday and closes higher than this close for the 27th, and that will be a qualified and confirmed breach of this supply line to the upside. And there's a qualified demand projection down here at 3602.86 from this qualified demand line. However, this will not be reached anytime soon, as there is an ATM pullback alert for some upside. As an example, back here on the 1st of September, you can see this ATM pullback alert up. Took a couple of days, but then it had some upside after that. The propulsion level for 50% momentum down could become qualified with a close below that level. D wave up wave 4 has printed here on the 15th and traveled down to here, and it is valid as it has passed the 38.2 Fibonacci retracement required for the wave projection 4. And for D wave upside, the mark has the projection for D wave 5 at 4349.75 based on highs and lows. And here's my version for closes at 4204.90. And for D wave, what needs to be watched out for to the downside, if there's a low lower than this low on the 3rd, then this 2 will shift over to where the 4 is. And the cloud baseline and conversion line have been right together for the past week, traveling up and down but staying together. And price has been staying at or under the channel 3 low for a few days back here, and that warrants a change in direction to the upside. And again, this pullback alert up could be the sign that there's more upside in store. And you can see how significant this bottom was that I called on the 13th for the big fat juicy gap zone, where we got the D wave up wave C, and the megaphone by 7 end count was down here printed 2. So that's a good sign of a bottom, but that does not mean it can't be revisited, and probably will be eventually. And price bottomed right on the trend factor down 3 the other day on the 22nd, nailed that and bounced up. So that's quite significant, but that doesn't mean we can't visit down 4 down 5 and down 6, where I'll still be a buyer down in these areas here. Probably not until it gets to down 5. And the relative retracement that's anchored at the low here on the 13th had plenty of chances to qualify and confirm the up 1. There was a chance here, 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 and here, about 3 or 4 chances, and it did not work. So that's still acting as resistance until it becomes qualified and confirmed. The S&P 500 daily cloud chart shows price breaching the bottom of the cloud at 3805 and then recovering to get back above the cloud, which was very close together for a few days, starting to widen out now. The lower Bollinger Band is under there at 3777.08, and the cloud lagging line for the 27th will reach this baseline here at 3804.62 quite possibly, and that coincides with the bottom of the cloud over here for the 27th, 3805.43. so this bottom of the cloud should be very good support, as it will be using the baseline 26 bars back concerning the lagging line for support. And there are several options for defining ranges. First one could be this ATM chart lines long-term oversold up here at that level, and then the ATM chart lines long-term overbought down at this level. And then there's the TDST lines. Here's the sell TDST, and then the buy TDST, so that can be considered a range. And then there's my version that's been on this chart for a while, the bottom of range 2 at 3723, and the top of the range, which is the former bottom of range 2 at 4163.72. And here's my version of the range in light blue, 3723, 34, 4163.72, and it's based on prior highs and low range over here, 2021, November and December, and then the high range around April and May of 21. And you can see over here, besides all the volatility we've been having, it's been very good support here on the lower range. And then at the top range too, you can see this area up here where it just went parabolic and came back down, but still pretty good resistance up here. The S&P 500 weekly chart looking back to COVID crash 2020. We'll zoom into the current area now. And the weekly chart has printed aggressive, sequential, and combo by setup 3 count. And to negate that for end of day Friday for this coming week, there must be a close above 4071.70 for the price flip to the sell setup 1 count. And the cloud conversion and baseline are just about together like in the daily chart. And to reiterate, the cloud is not valid for the weekly chart. However, I do use the conversion line and baseline as support and resistance for the weekly chart. And price has been under the channel 3 low for 2 weeks. It can get under there, as you can see over here it spent a lot of time under the low channel 3, so it can also spend just as much time above the high channel 3, as you can see here and a couple of times here. And the Bollinger Band uses the 39-week middle band moving average with 2.5 standard deviation on the upper and lower bands, so you can see the wide berth that allows here. However, the lower band has planed out and started bumping up a little bit. And that's a very good sign, as if there is a drastic pullback in the first half of 23, it should find pretty good support around 3,400, maybe by then 3,500. And price is just about in the middle of the ongoing supply line at this level, and then an ongoing demand line at this level. So that's becoming narrower and narrower. And we'll have to break to the upside or downside one way or the other. And D wave is on D wave, up wave 1 and down wave A. So we're concerned with the up wave, and the 1 has not printed and will if it ticks higher than 4,100.51. And that's close to the area in the daily chart where the ATM chart lines overbought is at here at 4,100.96. So make note of those levels, and let's see where the channel 3 high ends up for the beginning of next year, along with that chart lines overbought area in the daily chart. The NYA top caller chart shows the NYA to SPX ratio, basically value versus growth, breaking out of an ascending triangle pattern, which is very bullish. So value shows no signs of stopping its trouncing of growth. And the NYAD line, which is obviously geared towards growth, is not doing much. It's below its 50 EMA in green here. You can see here that when the AD line peaked and started going down, value started trouncing growth. And conversely, when value had its day in the sun and headed down where growth was trouncing value up here, you can see the AD line making upward moves. And the ratio adjusted McClellan breadth oscillator is below 0 and has been, so it's forming a complex pattern somewhat under 0. After having a nice complex pattern way above 0 for a long period of time. So that was quite a decent run we had. And the NYA price indicator shows it clearly blasted past and above the measure rule for the big W pattern from B to C, and then moved up here, so it made it well above that, and then rolled over. It's been trying to get back above it, and I have been able to draw a trend line here, so let's keep an eye on that, as that will be resistance now. However, price is not rolling over and dying when it hits these green horizontal support and resistance lines here. So it went under and fought its way back up, and it's now back above it a little bit, still below its 21 EMA signal line and its 10 EMA signal line. You can see in the thumbnail the red one and the green one. The ratio adjusted McClellan volume oscillator is below zero, forming a complex pattern like breadth. And you can see the ratio adjusted McClellan breadth summation index that's based on the ratio adjusted McClellan breadth oscillator made it up past 250, about 325, rolled over, went back under zero. That's a bad sign there. Same thing with the ratio adjusted volume summation index of the ratio adjusted McClellan volume oscillator. It's right below 0.2 at negative 12.92, not a good sign. However, the RSI 14 did make it down to the 40 area and bounced up. Maybe we'll get a mean reversion bounce. It would need to get back above the equilibrium line at 50 and then the 21 EMA signal line in blue. And the on balance volume for the NYA is slightly back above this downtrend line here, used for support and resistance, mainly resistance it looks like, so it did make it back above that slightly right here, but then it has another support and resistance trend line here to get back above, so it's stuck in this little zone here and below its 21 EMA signal line in blue. And the New York AD line is similar to the on balance volume trend lines, where it's trying to get back above the support and resistance line here. It's yet to get back above it, but it's been trying, so maybe the third time is a charm. Again, if it makes it back up into there, it's still below the 21 EMA signal line in blue and this other support and resistance trend line here, mainly resistance it looks like. And the divergences shown by the McClellan breadth oscillator for the New York AD line stocks only has served us well. You can see the divergence here in the McClellan oscillator was pointed up and the AD line was pointed down, so that would have been a good time to get on board for the upside. And then as it started getting near the top, you can see that the McClellan breadth oscillator started having a divergence down here as the AD line was going up, so you can think of the AD line as price action. And the intermediate term volume oscillator for the NYA, it was mumbling up here. It looks like it had its moment that it wanted to pause and then head higher, and then rolled over completely, went below zero, and is fast approaching this support and resistance line here, mainly support back here. Same thing with the intermediate term breadth oscillator. It rolled over, went below zero, and is approaching its support and resistance level line here. And the percentage of instruments above their 200 period simple moving average fell back below 40 and is trying to get back up above it after having a nice run when above 50. I thought we were really on our way to S&P 500 4,300, and then Powell spoke. The New York high-low index, similar to the NASDAQ high-low index that I show, corroborates the NASDAQ high-low index with this dotted vertical line where the 5 went under the 10 in red. and was within plus or minus 5 points of 0 for the ROC 12. You can read about the high-low index here, and I'll add that the 5, 10, and 21 EMAs are of the simple 10-day simple moving average. The NYA monthly chart shows that the price line is below the 12 simple moving average in red in the thumbnail over here, but we're more concerned about the indicators under here. The KST long term is slowly grinding its way back to 0. We were thinking that this might be similar to 87 crash, where the KST didn't make it down to 0, while the Coppock curve and the PPO did make it below 0. So the Coppock curve looked like it wanted to hook around and head up, and that would have been the buy signal. Then Powell spoke, and the PPO is leading the way and is still pointed up after hitting the support line zone here from where it had instances of hitting it before, bounced up, and now it looks like it wants to roll over, and that would set a precedent if it did that. But we're more concerned with the Coppock curve pointed back down again. It still has a chance to plane out, go horizontal, and then hook around and go up like here. And the NASDAQ high-low chart for the weekly study has no indication of rolling back up to the upside. It looked like it wanted to recently, however, it headed straight back down again, so there's no indication of that crossing back above its 39 period moving average here. You can see in past instances it would plane out horizontal and then just by virtue of going sideways get back above the 39 moving average. Another instance here, another instance here. And the COVID crash was insidious. So the buy signal for getting back into the big cap mega techs is a long way away. The FXY to UUP relative performance ratio shows the yen trouncing the dollar. We went long the yen back in October but did not short the dollar. In hindsight, that would have been a good thing to do. It will probably turn out to be the best pair trade of the year. And recently, Kuroda is retiring soon, so he made an adjustment to their 10-year government bond ceiling. So they raised it to 0.5, so 0.5%, and you can see it started climbing up, and that sent the world into a tizzy. As far as the other countries' 10-year rates are concerned, as the Japanese are one of the largest holders of U.S. Treasury bonds, that they could sell those to prop up their currency and bond. And while that's downplayed in the media as not being a threat, it is definitely a threat, and the U.S. 10-year note has been rising steadily since that announcement by Japan. So between the Japan announcement and the Fed dot plot being raised to 5 to 5.25, The bond vigilantes here in the U.S. and abroad selling U.S. Treasury notes could bump this up back to 4.6 and beyond, possibly 5%. So the U.S. could be headed right back into both bonds and stocks sinking at the same time, nowhere to hide. And the TNX CBOE 10-year U.S. Treasury Yield Index on the monthly chart shows that 5% up here as a ceiling and then a floor of 3.5%. And there's other ones underneath, 3.0, 2.5, but we won't have to be concerned about that for many years, more than likely. You can see the RSI has been in the nosebleed area for a long time and has no indication of heading back down for a mean reversion bounce around 50, similar to the 80s era. You can see the big bounce down. I do not believe we're going to see this happen over here. The US dollar on the daily chart shows the super bullish wedge pattern with the horizontal line around 113 and this right angled and descending line here. And you can see the floors at 105. It paused there and then hit 103. So 103 is the floor currently. If it breaches that to the downside, then it could be down to 101. And take notice of the preying dollar diffusion indicators at some very low levels below zero. So there could be a bounce up for the dollar, which would coincide with a bounce up in the 10-year Treasury yield. The NASDAQ 100 index NDX shows it resting right on its support line here at 10,944. There was a close of 10,985.45, so slightly above that line. And for next month, these two lines here, that horizontal green line and this extreme trend line going back to 2010, which it has not broken under, a little bit here, but there was a bounce back up, so no closes under that line, and that could come into play for next month as those two lines converge right there. So it will make it that much easier to get under that trend line in blue and the horizontal support line also. And the NASDAQ 100 AD line shows it going under that middle horizontal support line here. And now I've drawn a dash, and now I've drawn a dashed line in blue here for support. So if it bounces up and down between this solid blue line on the top and the dashed one on the bottom and gets towards this extreme trend line going back to 2012 in brown and can get over there and then fall under it there, and that would put us into the risk of a secular bear market if that happens. And the S&P 500 monthly chart is similar to the NDX, but different in that it has a long-term support and resistance line from 07 to the present, and it has broken down below that and is below the 36-month simple moving average at 3857.94. So that's an ominous sign. Then it has this horizontal support to get under here, and then another one here. And then if it eventually gets under this dashed blue support line here, going back to the financial crisis crash in '09, that will be the killing stone and put us for sure into a secular bear market, but that is a long way away there. More concerning is the S&P 500 AD line, which I have reconfigured. I've drawn a brown dashed line here pointed down, and then we have these horizontal lines here at the top, which it has bounced off of, and a middle horizontal support line, which it is resting on now, and still slightly above the EMA 10 signal line. So if it breaks under that 10 EMA and that middle support line here in solid blue, and that goes after this horizontal line here on the bottom, gets under there and goes after this angled dashed brown line and gets under there, that for sure puts the S&P 500 and most of all the world into a secular bear market. Take notice of the Coppock curve for the monthly chart down here. It had indications of hooking around, and then Powell spoke and down it went again. It's headed straight down and has no indication of flattening out and curling back up like back over here. This is what we're waiting for. The value line geometric index chart on a monthly basis shows it going under its 8-year moving average, or 96-month recently, a few months ago. Came back up above it and looks like it wants to test it again. More importantly, the Coppock curve for the value line geometric index shows it breaking below this trend line here in green and going under. It looks like it wants to hook back around, but it's really not even close yet, but at least it is not going straight down.